Good afternoon and welcome to Eleving Group's earnings call. We will start with company's presentation followed by a live Q&A session. We are looking forward to receiving your questions. You can either submit them in writing through the Q&A window or raise your hand and be unmuted after the presentation is over. For your convenience, we are recording the call and replay will be available shortly afterwards. That being said, I'm turning the call over to our hosts, Eleving Group CEO Modestas Sudņus and CFO Māris Kreits.
Thank you very much, and good afternoon, everyone. Welcome to Eleving earnings call, the call for the first 9 months results of 2025. So today, together with myself, we also have Māris Kreits, our CFO, and we'll walk you through key highlights of first 9 months, key accomplishments, operational updates, and then similar developments. Before jumping in, still to shortly summarize these first 9 months, and actually the biggest emphasis we will put on the third quarter, which was actually very good for the company and which shows that we are on the right direction. Many financial indicators have improved significantly, so we'll walk you through those figures and also the initiatives which we have launched in the first half of the year allowed us to achieve those results. So we'll provide some specific updates on that. So now, without further ado, let's start with group performance. I believe this is slide number 4. Here, as always, we show 2 core figures: net portfolio and revenue. Here we start with net portfolio development. During first 9 months of this year, like our portfolio have grown to 409 million euros, which is comparing to the same period, which is the same period last year, which is 10.3% growth. But worth to mention that more than 30 million of this growth came in the third quarter alone. So we really picked up the growth pace at the second part of the year. If we look at the split, so we remain very well diversified between our 3 key product categories that you can see on net portfolio split, same as on revenue split. Still, if to call out one group which grew most in a proportionate terms, this would be flexible and subscription-based products. And here there are 2 main reasons. So one, our motorcycle financing product, especially in Kenya, these so-called BODA loans, they are developing very nicely. We see very good traction in the market. And secondly is the new product, which we have launched by now already in 2 markets, Kenya and Uganda. So these would be smartphone financing. So these 2 factors were the key drivers for the growth in this category. But overall, if we look at the revenue part, we see that the revenue actually grew even at a higher percentage compared to net loan portfolio, which is always a good sign. And over the first 9 months of this year, we have generated 178.8 million euros of revenue. Of course, also I can't not mention probably the biggest highlight, which happened just recently, a few weeks ago. We have raised 275 million euros Eurobond. So this is by far the biggest in company's history. So this is a 5-year instrument with a 9.5% fixed coupon. And as already communicated, a big part of that coupon of that bond will be used to refinance existing liabilities, 150 million euro bond, which had already actually been done. But 125 million euros in the long run, all of this amount will be used to support our growth and in further investing in our growth of net loan portfolio. So we had very strong demand. I guess best indication of that is post-trading, where we see that actually already this new instrument is trading with a healthy premium. So very happy with good support from the capital markets. Now let's turn to the growth slide, slide number 5, to go a little bit deeper in some of the initiatives, what we're doing. Starting with overall sales numbers. So in the first three quarters of a year, our sales were 325 million euros. Just as a comparison, in the first 6 months, it was 200 million. So there's a healthy growth period over period. This is 23%. But what's also important that it comes on a expense of receiving more applications. That means we're not sacrificing our underwriting policies or becoming more loose when it comes to customer evaluation. That's not the case, actually. We just see a overall growing demand for our products across different product categories, different sales channels, and similar. We'll cover that in a little bit further slides. But probably most important things when it comes to development are still new product launches. So a bit more flavor on smartphone financing product, which we launched 5 months ago in Uganda and then 3 months ago in Kenya. So by now we've already built slightly above 6 million euros net loan portfolio. So strong first half a year for this product. And having close to 150,000 of unique applications allows us to still be selective, but at the same time maintain healthy growth ratios. And then just to maybe a reminder for the listeners that we start with focusing on financing self-employed people in these markets, and a big part of them are our own former customers, like so-called boda drivers, so taxi, cargo, food delivery drivers. And also the other very important direction is, I would say, customer retention activities, which are done while implementing new products in our European markets, in EU markets. These would be installment loan products, where we are approaching our existing database of car financing, especially in these mature markets where we've been operating for 10 plus years, and offering for people to take additional loan product that had showed very good potential. And already in third quarter, on average, 4 million euros of sales per month was generated just through these retention activities. And we don't plan to stop here. We still see that there's quite a lot of potential to grow further. Last one, the expansion side, on geographical expansion side, we launched our 17th market, which is Tanzania. So we received a license from Bank of Tanzania, and we launched our first branch in the capital city. So far we're starting with motorcycle loans. We believe that this is the best product to start, and then we actually see very lively market there, and then lots of growth potential. And in upcoming months, core focus will be, of course, testing business model and slowly expanding our branch network, going into different cities, opening new branches. But in short to midterm, we also don't disregard to add one more product where, let's say mobile phone financing. But again, still at first we need to test the market hypothesis for a secured product for the motorcycle financing. So we'll be obviously providing more and more updates on this development. And lastly, even though we had plans to launch 1 to 2 new markets this year, we ended up launching only one. But we have in quite a few markets a good progress, and we do believe that at least one more new market will be launched in first half of next year, and then probably for next year we target 2 new markets being launched. So on that we'll also be updating you on a quarterly basis. Now we can go to the next slide. So our geographical footprint here, to be honest, no significant changes. If we look to the left in terms of product split, so in blue you can see our consumer lending products, which is 1/3 of the business, and 2/3 of the business are in secured financing products, split between traditional vehicle financing and flexible products. So really no changes here. If we look market per market developments on vehicle finance side, worth to call out and mention 3 biggest markets. So this would be Latvia, if we include this off-balance sheet product for us, Primero. Romania and Kenya. So all of these markets have around 50 million euros net loan portfolio and continues to develop nicely. On consumer finance side, as always, biggest market for quite some time already been Albania with close to 40 million euros, and growing market Botswana, which is already at 27.5 million euros. But if you look at all the rest markets, all of them are in category of having between 10 to 30 million euros net loan portfolio. So really the best word to describe this slide is diversification. We maintain very well diversified per product categories and per geographical split, and that has been our strategy over past years and will remain going forward. Now let's turn to the next slide. Our non-financial KPIs. Let's start with vehicle finance. So here we really see a lot of green color, and just as a reminder, here we show the change quarter on quarter. So both on applications received and vehicles financed, the growth is above 20%. And as a result of that, we managed to increase our issuance as well, not affecting our conversion rate, which stayed pretty much flat. On consumer finance side, we see slightly different view. Here, the growth, I would say, is pretty much flat. Applications received were 2.5% more, but this was mainly driven by our African markets. In Balkans, we were really flat, and number of loans issued were also flat. But here we have a little bit different strategy. Like in quite a few of these markets, our focus is returning customers. And then actually offering them bigger tickets, longer maturity loans. So this is how the net loan portfolio growth is fueled, and this will be the kind of strategy for the remaining periods as well. On the conversion side, we see that it slightly went up by 3.8 percentage points. But here again, it's more like a seasonal effect, depending on some sales channels. Like we have not been changing our underwriting policies much, just as always calibrating to be more accurate. So overall, demand for the product is strong, and we're able to maintain our preferred underwriting policies in place to fuel the growth. Now handing over to you, Maria, for the financial part.
Right, thank you, and hello everyone on the call. So moving on to slide 8 with the financial highlights. Now let's start with EBITDA and adjusted EBITDA first. So as a very kind of quick intro, I wanted to still highlight the difference between the two metrics. So you'll notice that adjusted EBITDA in our instance is actually lower than the accounting EBITDA, and the difference accounts for, in our instance, during the first 9 months of the positive Romanian VAT case, which we successfully won in the appeal. And also we always adjust for minority share of profits. So that's why our adjusted EBITDA is always lower than the accounting EBITDA. But if we speak about these two metrics, so starting off with the accounting EBITDA first. So if you look for the first 9 months of this year compared to the same period last year, we actually see quite nice, more than 15% improvement in the EBITDA figures. And if you look at the adjusted EBITDA figure, the improvement is also still double digits, close to 13% growth. So of course, EBITDA does correlate with the key business driver of our company, which is essentially net loan portfolio and revenue as a result of it. So as we keep growing net loan portfolio, we do expect our EBITDA to follow. Same developments or similar developments you can also see on the next profitability metric here. So net profit and net profit before Forex. Net profit has actually increased also in double-digit percentage territory, close to 12% increase. If you look at the net profit for first 9 months and compared to the same period year before. And even more so, our net profit before Forex has actually increased by more than 27% during the first 9 months of this year, if we compare it to the first 9 months of year 2024. And here the difference between these two growth growth of net profit before Forex and net profit after Forex attributes to the really, I would say, extraordinary developments in the currency markets, which was, let's say, dollars depreciation throughout the year. So which actually dragged quite a lot of emerging currencies with it if we compare with the euro currency. So as a result of it, you'll notice bigger FX expenses in our P&L as our cost of hedging, as well as generally revaluation of our businesses in euro currency happens. Nevertheless, if we look at the equity development, we see that with the organic equity growth, meaning profits, we were able to support dividend payout during the first 9 months of this year. So here I refer to the first dividend payout, which happened in month of June, where we distributed half of year 2024 profits. At the same time, we have continued to gradually and smartly repurchase minority shares. As a result of that, we are keeping or transferring more profits to the parent entities shareholders. And lastly, we're able also to absorb same already previously mentioned FX movements. And in this case, these are changes in the foreign currency translation reserve directly in equity. All taken together, our equity remains above 100 million euros. And even more so, our equity to total assets ratio remains to be substantially high, which is about 20%. If we look at the figure or the ratio as of end of September of this year. And all in all, the profits and equity, you can also see that resulting in return on equity ratio, which is about 30% level, which we have set as our, let's say, internal target, which we already have communicated also numerous times during our earning calls. So we're happy with this development. That means that our shareholders are realizing a nice return on equity from their investment. And lastly, on the cost-to-income ratio, here we can also bridge with the developments of net loan portfolio and revenue. As we keep growing net loan portfolio, we keep increasing revenue base. All our expense base also increases, but the revenue increases at a faster pace. And here we see this nice gradual improvement in the cost-to-income ratio, which is trending downwards quarter to quarter. Now moving on to the next slide, please. So here in this slide, on the upper left part of the slide, we have our liabilities breakdown as of end of September of this year. Here you can see still, quote unquote, the old picture. So before the new bond was issued. As of this moment, as of end of September, we still had 150 million euro bonds and also 90 million euro bonds. We were using quite a lot of Mintos Marketplace for loans as our more like a revolving credit line type of facility. And there we had 64.1 million euros as a balance. At the same time, we're really happy with the developments of local bonds and notes, and this position has been increasing gradually. So as of end of September, we stood at 42.8 million euros, largely thanks to local notes in Kenya, Botswana, as well as in Albania. And on top of that, we have also unlocked new bank loan facilities in such markets as Kenya, Uganda. And you can see that also loans from banks portion increasing gradually. And even more so, we have quite a nice pipeline of new local debt facilities that we are expecting to unlock during this quarter, specifically in the markets as Georgia and Armenia. But now also touching upon on the new bond issuance. So during the month of October, we issued 275 million euro worth of Eurobond. Part of that Eurobond was supported by existing bondholders of 150 million Eurobond, and that what happened in the amount of 61 million euros. The remainder of 150 million euro bonds have already been repaid as of end of October. And we have also started the gradual repurchases of Mintos loans. And as of this moment, we have already addressed half of Mintos portion, and meaning that we have already repaid more than 30 million euros from the platform loans, and we expect to continue to do that also in the upcoming month. And by end of this year, the Mintos facility will be temporarily repaid. But of course, we expect to remain active in the Mintos platform as we keep growing our loan portfolio. On the lower part of the slide, you can see our financial covenants. Here, the story is quite simple. We operate with quite a nice and high headroom over the minimum allowed levels. And that you can see in the interest coverage ratio, the net leverage, as well as in capitalization ratio, substantially increasing or being above minimum required levels. Now, moving on to the next slide, please. So here in this slide, we have our loan portfolio quality breakdown. As always, we're showing the vehicle loan portfolio and consumer loan portfolio separately. If we start with the vehicle loan portfolio first, so you'll see that our NPLs and net loan portfolio as of end of September were at 4.7%. And in the consumer business segment, we had 4.3% of NPLs. Worth to mention the gross NPL development on the right-hand side of the slide. You can see that they have been trending downwards for both business segments, both vehicle and consumer business segments. And this happened largely thanks to quite successful bad debt sales, especially in the markets such as Romania, Estonia, Moldova, as well as in Latvia during this year. And on top of that, we're really happy with the loan portfolio quality in our African markets, especially in the vehicle business segment in Kenya, Uganda. The new loans that are being issued, we're issuing with very high quality and very high repayment discipline. And of course, that impacts positively the gross and net NPL ratios. Continuing on now to the slide 11. So on our share performance, our share price has been trending around the IPO price, which was 1.7 euros per share. Having said that, although the share price has been stable, we believe that the share is quite a bit undervalued. That you can see also from the analysts' estimates. So all four analysts that are tracking our company expect and calculate the target price being substantially higher than it is right now. And also you can see that in the PE ratio, which is at 6.3 times, which let's say you could say is quite a bit on a lower side, and there's a quite a substantial upside potential there, and that is already evidenced also with the return on equity. And the company that operates with 30 plus return on equity, or as a company like that, there is a good potential also for the share price to improve in the future. Now, if we continue to the next slide. So here in this slide, we're looking back at the financial targets for this year that were set at the beginning of this year and actually during our IPO process. So we proactively and publicly communicated our financial KPIs for next 3 years. So these are KPIs for year 2025. So 3 major KPIs being net portfolio, revenue, and net profit before Forex. If we start with net portfolio first, so we have added more than 30 million euros of net loan portfolio just in the third quarter of this year. And given the fact that fourth quarter usually is the high sales season in our business, we do expect that we should be able to actually not only meet, but even slightly exceed the target for net loan portfolio as of end of this year. Then on the revenue side, similarly to net loan portfolio developments, we do see that we have all the conditions in place, net loan portfolio growth being the primary one for us to reach the target that we have set for this year or be very close to it. And lastly, on the net profit before Forex, So again, over the last 2 quarters, we have been consistently adding 11 to 12 million euros per quarter to our net profit before Forex line. And we believe the target being 44 million euros for the full year is quite achievable, especially given our recent developments. And then on the upcoming dividend payment, so we are starting our first, let's say, post-IPO semi-annual dividend payout cycle. Still a reminder, we did make a dividend payout during the month of June of this year, but that dividend payout was special in the sense that we paid half of full year profits, full year 2024 profits. And now we are starting these semi-annual dividend payout cycles, and we kick off with a proposed dividend payment that would happen during the month of November, where we would distribute a portion of first half of this year profits. So we as management, we propose to distribute 4.86 million euros in dividends for this period. That together with the dividend payout that was done during the month of June will make the total figure of dividends paid during this year close to 20 million euros, which from shareholders' perspective, from a realized cash dividend yield would mean that the shareholder would have made a 10% return on their investment. And the actual dividend payment is expected to be approved during the management board meeting on 14th of November, with the ex-dividend date being 20th of November and potential dividend payout date being 28th of November of this year. However, I would say these are estimated dates. There might be slight changes in these. So therefore, please do follow the announcements we as a company will be making in the stock exchange during upcoming few weeks, specifically on the dividend payout mechanics and timeline. Right? I think that's it from my side. Turning back to Modestas now.
Thank you, Marius. So now the last slide of today's presentation, business outlook, and since we finished 3 quarters already, so we thought that we'll put these statuses for particular goals what we had set for a year. And if we start with products and markets, I guess most achievements we have managed to succeed in is related to our products. So we have on vehicle Europe, we have successfully launched consumer loan products and continue to scale them up. We have not launched a new market, which we were considering, but that is postponed for the upcoming year. On the African side, one of the biggest projects is smartphone financing launch, what we already covered. And as already mentioned, like we have launched a new market, which is Tanzania. And on consumer finance side, we continue our strategy of working a lot on retention, on better utilization of our databases, not only in this obviously part of a business, but across. But here, this is the highest emphasis. But that being said, we also plan to launch few new products, consumer loan type of products, but more targeted for more specific needs. So so far, quite a bit of focus, let's say in our Balkan markets was loans to finance some consumer electronic purchases or some other smaller expenses. We plan to launch slightly bigger ticket loans to finance things as home renewal expenses and similar. So all of that is planned to be done in the 4th quarter of this year. When it comes to capital management, I guess obviously the biggest highlight is already covered, 275 million euro bond raise. Also, what Marius have mentioned, like we're very happy with our local fundraising activities and diversifying our currency hedging tools through that. So that's on very good track. And lastly, if we look at governance sustainability, I do believe that we are on the right track, and we are finalizing our ESG strategy, carbon neutrality kind of plans. So by the end of the year, we're going to be I'm quite confident that we're going to achieve most of these goals. So summing up today's presentation, first 9 months of the year were really good for a company, but definitely third quarter stands out the most, where we breached some of the gap which we built partially due to currency exchanges, partially just due to slightly slower start of the year. And we do believe that we're on very right track. We have launched a lot of successful initiatives which fuel our growth, fuel the development of the business, and we're very positive that we'll be able to maintain this dual track growth, but at the same time maintaining or actually improving our profitability going forward. So with that, we're finishing today's presentation of slides, and then now we're ready for your questions. So turning back to you, operator.
Thank you. The formal part is over. Let's now look at the questions we have received from our participants. Please submit them in writing through the Q&A window or raise your hand to be unmuted. We will start with the questions submitted prior to the call, then we'll take the audio questions, and finally continue with those submitted in writing through the Q&A box. Since there are a couple of questions about dividend payouts, do you mind reminding what dividend amounts and when will be paid out, and why is the 30% distribution?
Yeah, so we are proposing to distribute 4.86 million euros, and that is expected to be done during the month of November. On the exact date, so our initial timeline is 28th of November, with ex-dividend date being 20th of November. However, since this is still an ongoing process, please do follow the stock exchange announcements on the amount. On the ratio itself, so let's say here in the amount which we are proposing, we took basically two things into account. First, our dividend payout policy, which is publicly available. So here it talks about the fact about the ratio of the profits that we can distribute and how it correlates with the equity ratio post-dividend payout. So we took that into account. So where our equity ratio would stand immediately after the dividend payout. And secondly, we also did take into account the fact that we had quite a sizable dividend payout already during the first 6 months of this year, which again brings the total dividends paid for the year at close to 20 million euros with a realized cash yield of 10%. So all these things were taken together once we announced and once we are proposing the dividend payout payment to be made during the month of November.
Thank you. I don't see any raised hands, so I'll continue with the questions submitted through Q&A. Same topic about dividends. In the report, Business Outlook for 2025, you mark that you maintain a 50% dividend payout ratio with semi-annual payments. But in fact, for this half, you plan to pay only 40%. Can you please explain the difference?
Yeah, so let's say in the business outlook, so these are goals. These are goals which we would like to achieve and which we set for ourselves, for the company. At the same time, once we made the dividend payment ratio proposal for the dividends, which we already talked about, on top of the things which I already spoken about, we did also take into account the fact of how the company develops, how the company is growing, and the company's net loan portfolio has been growing quite nicely and rapidly, especially over the last several months. So to support the growth and to have this sustainable, profitable growth in the long term, that decision was made for the specific dividend payout ratio during this half of the year. But nevertheless, I think our mid and long-term dividend payout ratio target remains the same. and it will always be tested and calibrated depending on how the business develops. And we really see, as of this moment, business developing really nicely and the business growth exceeding the pace that we have set for ourselves, which at the end of the day will be net positive or economically positive to our shareholders.
Yeah, I think nothing to add from my side.
Thank you. Let's talk about the recently issued bond. Why do you consider the new bond a success when it immediately trades at 104? Isn't this a sign of mispriced issue? And where these 10 million transferred from you to bondholders?
Good provocative question, I guess. So first of all, worth to mention that we have ended up pricing the bond at the lowest range which we have initially set, and it's always a, I guess, open question how to best come to this initial levels, initial ranges, and in our case. We had to look where our existing instruments are trading at, and they were trading at 9.5 or slightly above that. So that was one indication. Also, we had to take into account that there was an exchange offer element, and actually 60 million or even a little bit more than that have rolled over from 9.5% coupon instrument to the new one. So kind of for them to also make sure that they have this comfort and they know that they would be getting at least the same coupon was one of our goals. And in terms of instrument or bond trading above par, actually, first of all, it's a very good sign and a healthy sign for the bondholders. It shows that there's a strong demand in the market, and I think company, especially a company which has aspiration to get back into capital markets and continue raising, I think it's a good sign when this happens. In terms of level, could it have been slightly lower? We as management always have aspiration to get there, and we believe that we will get there, but in upcoming bond raises, and also we need to look who are our who were the main investors. So this was a little bit more institutional demand-driven transaction. So we really had a lot of discussions and negotiations with our, let's say, main supporters, and we do believe that 9.5 coupon range and kind of fixed coupon, it's a good compromise for the company as well as for the investors. So we're actually very happy with the amount, and we're very happy that it is trading up.
I can only add to that. There was also last question: was there some 10 million moved from the company? So there was no trades involving the company itself. So there was nothing which came from us as a company in the secondary market trading. If that's where the question was leading to.
Thank you. Our next question consists of 3 parts. What has driven the significant increase in motorcycle taxi loan product applications in Africa? What type of risks do you see for this loan product from credit risk perspective? And do you see the underwriting percentage increasing in coming quarters?
Sure. Thank you for the question. So I guess answer is not so straightforward because we've been kind of growing our number of applications gradually. It didn't happen over a few months. And then we actually have changed slightly our business model over the last few years. If someone remembers and was tracking the company, we started it a lot based on partnerships with motorcycle dealers. But actually we moved into the model where we ourselves became, I would say, one of the bigger motorcycle sellers and dealers. So we don't deal with stock that much. We're still buying it from the distributors, but we have expanded our number of showrooms. So in this case, we do not fight over some commissions with competitors, how much we pay to our partners. So that helped a lot to control that. But of course, as a result of this strategy, our branch network has expanded significantly, and we've moved also into a little bit more mobile branches. But this way, we do really control the customer flow, the customer experience, and then we believe that especially for Kenyan market, that was the right strategy. In terms of risks, in terms of credit risks, we have, I don't know which iteration of our underwriting model already running. It's fully automated. So I do believe that we're getting better and better in our kind of ability to underwrite the customers, and the recent vintage shows that we're definitely on the right track. So we're not so much worried that customers would change. I guess biggest worry would still be some macroeconomic effects which might affect certain country as a whole, and then would have certain turbulences, and it's not a secret that it does happen every now and then in African markets. But at the same time, we've been through already quite a few turbulences, and we do take that into account while providing, while creating our underwriting models, while also asking for the down payment from customers. Actually, we do have even higher and better results in terms of repayments to what we expected. So we still have quite some room to maneuver there. I think probably I answered all three parts of the question.
Thank you. Let's talk about the targets and your loan portfolio. Last time you mentioned that due to FX impact, it's likely you will not meet the 432 million loan portfolio target for the year. Do you see achieving it now after Q3 growth acceleration? And should we expect the growth to accelerate even more next year on new product and market launches backdrop?
So definitely, when it comes to this year targets, when we talk after 3 quarters, we're way more confident, as Marius mentioned, that we will reach the goal, and then probably maybe even slightly beat it, as December, end of November is the high season especially for consumer finance products. So yes, the answer to the first part would be yes, we're confident in achieving the goal. And in terms of growth for the upcoming year, do we see it more accelerated? If someone has checked our targets, what we have set for the company for the 2026, they were already quite ambitious. So far, we believe that this level where we are at, this will definitely help to achieve that. If it will beat it, I think a little bit maybe too early to tell. We also need to see how the new initiatives really scale up further, because still same Tanzania has just launched, same smartphone financing or our installment loan products. They definitely have potential to grow further, but we don't want to be too quick in that. And so far, we want to maintain probably the similar growth rates what we have currently. But again, every quarter, we're reevaluating our strategy, our risk metrics, and we might change some of the predictions as well based on the performance of these products.
Continuing from global to local, what has driven the loan portfolio growth in Latvia in recent quarters?
So two main reasons. One is more effective work with our customer database, current and former customers, and obviously having an opportunity to offer them different product, not only vehicle financing, but also just installment loan helped a lot, because people don't buy cars that often. So that was reason number one. And reason number two is our effective partnership with local bank through joint venture. It's been already, I guess, 4 or 3.5 years when we started this partnership. So now it's really working as a well-oiled machine, and then we're able to compete not only with non-bank lenders, but also with some of other, let's say, more technology-driven banks in the region and successfully grow this part of the business. So these two elements were the main factors why Latvian market is again on quite fast growth pace.
Thank you. What non-controlling interests share in net profits we should expect over mid to long term?
I think it's fair to expect the same level or similar level as you would see it right now, so approximately in the range of 15 to 20%. So this is something that has been there over the last several years, and there are no fundamental changes expected in that regard.
Thank you. Is the non-controlling cash out the same as a management incentive plan?
Yes.
I guess it is, yeah, it is part, not sure with cash out part, but in a way, our share option scheme is a management incentive plan, which we have implemented historically across multiple layers of the organization. And I would probably say for many of our top managers, this is the main part of motivation package. So they are shareholders and they do share part of the profits what company is earning.
Mm-hmm. A broader question now. How do you choose new markets?
With a lot of market research, it's probably 1 to 2 months process, which starts at looking at multiple markets. First of all, from desktop researches, legal memos, to afterwards actually physically sending the team, in most of cases, multiple times to evaluate a competitive landscape, meeting key stakeholders, evaluating economical situation, understanding the process of getting the license, and many, many factors. And at the end of the day, we always like to choose, from 2 to 3 markets, which we analyze in very much detail. So by now, having operating in 17 markets and probably historically we have opened close to 25 markets. Some of them we had to close eventually. Like we have a pretty much kind of well-functioning footprint how to do it and what needs to be checked.
Thank you. The long period forecasting is hard, but let's try to look into the future. Where do you see your company after 5 years at the end of 2030? What portfolio do you imagine? What net profit and what dividends?
Okay, I'll try to start on more general terms, and maybe Marius will be brave enough to talk about net profit and dividends. But when we're doing the IPO, we always were saying that we have an ambition to close to double the business in next 3 years. So 1 year has almost passed. I think we got to acceleration level where now it does look doable. So here, if maybe not 2030, but maybe more like 2028 horizon would be a doubling portfolio, or we think about 2030, so probably getting closer to 1 billion euros assets under management, assets of company and similar net loan portfolio. So we believe that could be a good aspiration for the company. And actually what we're seeing in majority of our markets, that consumer lending is kind of going through good times with a lot of demand, with also other companies doing well. So this is really doable. And I guess, yeah, I think it's always hard to predict, net profit levels, because we do operate in still quite dynamic market where, strategy needs to be adjusted every now and then. There's also global factors, especially if you look last 5 years, like no one could have projected COVID, different geopolitical situations. So I think these long-term, especially profitability projections are very speculative. That's why we try to stick to more 3-year kind of term projection, which I guess it's more in our own control. So from my side, that's it.
Nothing to add from my side.
Very well. What's the reason for postponing the second new markets expansion into 2026? Do you have the market already picked and its regulatory setbacks, or are you still deciding on a suitable market?
It's a mix of reasons. We're in a very developed stage for at least two markets, and like we were not rushing. Like we had the goal to open one to two new markets. One when we have launched, then most likely next year our target will be two markets. But one of the reasons is also very successful performance of existing markets and very successful launch of new products in the existing markets because we still need to manage our management capacity, our IT capacity, risk capacity in between the markets and our regions.
Thank you. Currently, we have three more questions to go. How do you maintain the balance of loan growth ambitions and discipline in loan underwriting? What is your macro view for the next 12 months?
In terms of maintaining balance in growth and underwriting, it's all boils down to data and risk department. The biggest growth, what we demonstrate, is in markets and in products where we have long track record. So we've scored thousands, in many cases, hundred thousands of customers, and we are able to predict their performance quite accurately. And then, afterwards, it's really based on your risk appetite, growth appetite. But we've been, I think, quite consistent in our risk management over the last 3 years. I would say we at this stage there is a possibility to grow through increasing, let's say, risk, which could also be a kind of profitable decision. But we like the level where we are at. We think that's good level to be at. It's kind of sustainable and long-term strategy. And everything else afterwards is done by our risk teams, which really control how many defaults we can absorb and how these underwriting tools are built. And in terms of macro, again, not very good with predictions of things which are a little bit out of our control. At least in our markets, we do see that there's no maybe talking overall that there's no kind of big turbulences are expected, at least looking from today's perspective.
Thank you. You have non-performing loans declining in the vehicle rent portfolio, while you are keeping relatively high coverage rates compared to historical levels. Could one expect some provisions reversal here, or what do your past recovery rates in this segment suggest?
Yeah, I would say that probably the reasonable expectation is that we will remain to be prudent in our impairment provisioning policy. So now, especially since we're growing the loan portfolios, both in the vehicle business segment as well as in consumer business segment, we're adding quite a bit of new loans, whose performance is still to be observed as they work through the full life cycle. So we don't necessarily plan to rush in releasing some provisions ahead of the time, or at least ahead of the time where we can reasonably expect this loan performance to be long-term sticky, so to say. So yeah, we probably will remain to be prudent in the midterm.
On motorcycle loans, you mentioned that you became some sort of seller instead of only depending on other dealerships. Does it mean that the company earns extra from selling services and being the dealer itself?
Very slight margin. It's in general it's very competitive and at the same time transparent market. All the dealers are buying motorcycles from the same distributor. So I would probably maybe put it differently, like we're able to package our financing product more nicely, having slightly lower motorcycle margins as well. So that just helps to sell motorcycles through financing, because we are not selling new motorcycles through non-financing activities, so through cash, only through financing.
Mhm. You mentioned you want to expand into home repair loans and higher ticket loans. Would you consider entering into SME and specifically agro SME financing in Africa?
So in terms of maybe short comment on these bigger tickets, I think that has been a gradual, strategy in some of the markets already for quite a few months. And this home repair loans, this is, I would say, it's more reaching a more targeted audience rather than introducing something completely new. And when it comes to SME, we were looking into this segment first of all in Europe for quite some time, and I guess some 6 months ago we've communicated that for now we will not do that. We are looking at potential acquisition targets in Baltics and in markets as Romania, but we couldn't find maybe the companies which would meet our requirement. And secondly, we are not experts in that at this moment, so that would be something completely different for us, because we are experts in financing kind of big B2C segment. And when it comes to SME agro loans in Africa, sounds very interesting. Just for general understanding, to be honest, we have not checked it. We just know that uh, agro is quite strong, let's say, economy in general, like in Africa, and we have quite a few investors in our local nodes from agricultural segment. But as of exploring SME, actually Africa is probably the region where we have the most potential to grow with a B2C segment as of now. So definitely not upcoming months, years plan, but maybe in long term, who knows?
Thank you. As we're running out of time, we'll now take the audio question and then finalize with the final question that we have received in Q&A. Frank, please.
Yeah, hi, gentlemen. Greetings from rainy Berlin to sunny Riga, I hope.
Unfortunately.
First of all, a compliment. Company looks massively different to the day when we first invested about 6, 7 years ago, whenever that was, and you have built something that's quite resilient. Resiliency seems to be a word that comes up all the time now in the language. So in terms of acquisitions, if you want to achieve your growth target, every now and then some of your competitors just don't make it. They don't get their refinancing, they sell their portfolios and so on. You're fully plugged into that flow and you look at that and you haven't really ever found anything you can pick up with well, it's called accounting wise, it's called a badwill, maybe buying something below what the book value would be. Has there never been anything coming up that whetted your appetite?
Yeah, thank you. Thank you for the question, and thank you for the greetings. It's always nice to hear from you. Either we are not looking careful enough, or really we have not seen such acquisition in the regions where we are operating. In African part, fair to say we every now get different certain offers, but I would say these are mostly distressed assets and quite small businesses, and then it's always a question whether it's worth the time to do the due diligence. But definitely, if acquisition would be possible, especially below book, below equity value in the markets where we know how to operate. That would be very interesting. Probably if something like that would be in some Latin America type of markets. I'm not sure if it would be really interesting, because it's still there's some learning curve to go through, entering different continent and so on. So we always think that we're open for these type of acquisitions, but
Yeah.
kind of not right fit just haven't come up yet.
Yeah. Okay, I appreciate that conservative approach to M&A. A lot of things can go wrong with M&A, and sometimes the best deals in M&A are those you don't do. Thank you very much for the transparency of the report, and good luck on Q4.
Thank you very much.
Thank you.
Thank you, Frank. So we'll finalize with the last question that we have received. Have you set some sort of ceiling on the desired number of markets you want to operate in, or what's the optimal amount for scale benefits?
I guess it's all a question about the time frame. So we as a company, we definitely are capable of launching 2 or even 3 markets per year because we have 3 separate regions which are quite independent from each other when it comes to resources. But at the same time, our job is to also look how the group as an overall is developing, what are the growth projections and similar. So I would probably say that we are limiting ourselves the appetite for some of our maybe management team members to scale up, but this 1 to 2 new markets per year so far, it's I think very comfortable level, and then we can launch new market without a rush. And with no optimal level, we can of optimal level of markets. We would be okay in 10 years to operate in 25 markets or even sooner. It's more all dependent on our own operational capacity, and we do believe that with every market launch and with every new, let's say, euro issued, we're becoming more and more efficient organization because still we do have certain operational capacity, having this regional structure to add more, and especially for the markets, where we've been operating 10 plus years, they don't need so much kind of attention anymore, and then we can dedicate a little bit more time to the new markets. So all depends on the time frame.
Thank you. Now, all questions have been addressed. Before closing the call, I turn back to Eleving Group's management for the final words.
Thank you very much. Let me once again thank you everyone who has joined the call. Thank you for a lot and the insightful questions. And we look forward to the future calls and interactions. Have a good week.